Ladies and gentlemen, Asian guy here. Take a moment and think back to yesterday. Think back to Christmas morning. Think back to that quiet moment when most people believed the markets were calm, stable, predictable. That calm was a lie, because what you were watching wasn't stability, it was silence. And silence in markets is never peace. It is absence. Absence of liquidity. Absence of sellers. Absence of gravity. For weeks, the signals were there, subtle at first, then unmistakable. Silver wasn't sleeping. Silver was being held down. And when pressure builds inside a closed system, it doesn't release gently. It explodes. Yesterday morning, when the market opened, silver did not move. It teleported. And the most dangerous part? We warned you this would happen. The illusion of a healthy market. Most people think markets move like waves. A buyer steps in, then a seller, price inches higher, then pulls back. A tug of war, orderly, controlled. That's how markets behave when liquidity exists. Liquidity is the invisible force that slows price down. It's friction. It's gravity. Remove liquidity and price doesn't walk. It jumps. For months, silver appeared stuck. Every rally was capped. Every breakout faded. Analysts called it boring. Traders called it dead money. But boring markets are often the most dangerous ones, and because suppression looks exactly like stability, right until it fails. There are two silver markets, and confusing them is how most people lose. The first is physical silver, bars, coins, metal you can touch. Metal that must be mined, refined, transported, stored. The second is paper silver, futures contracts, derivatives, synthetic supply created with keystrokes. Paper silver sets the price. Physical silver pays the bill. And for decades, the paper market has flooded the system with artificial supply. Not metal, promises. This is what kept silver cheap. This is what kept it under control. But paper supply only works as long as people believe sellers exist. Yesterday proved they didn't. What is Ghost Week and why it matters? Markets don't break randomly. They break when conditions align. Ghost Week is one of those conditions. Holiday trading, shortened sessions. Senior decision makers gone. Desks half-staffed, liquidity thin. In a normal week, a moderate buy order barely moves price. 10 cents, maybe 20. In Ghost Week, that same order can rip through the entire order book. Because when no one is home, there's no one left to sell. This is why professionals fear holiday trading, and why amateurs sleep through it. Yesterday morning, liquidity wasn't thin. It was gone. The warning signals. Most people ignored the clues were everywhere. Vault drawdowns accelerating. Physical premiums rising quietly. Backwardation whispers. Delivery pressure building under the surface. Meanwhile, paper prices stayed calm. Too calm. Calm is not neutral. Calm is pressure building invisibly. Like standing in a room filled with gasoline, waiting for a match. We said it clearly. When this market breaks, it won't tick higher. It will jump. And that jump will not ask permission. Why this move was never about demand. This is the part most people misunderstand. Yesterday was not driven by aggressive buying. There was no frenzy, no panic crowd, no viral moment yet. The buying wasn't the story. The absence of selling was. Markets don't need demand to explode. They need lack of supply. When sellers vanish, even small orders become weapons. And yesterday morning, sellers vanished. The fatal assumption. Short sellers made one fatal assumption. They believed they could always buy back lower. They believed liquidity would always appear. They believed suppression would always work. It works until it doesn't. And when it stops working, it stops all at once. No warning bell, no graceful exit. Just forced liquidation at whatever price exists. Yesterday proved that price didn't exist where they thought it did. Why the calm was the real danger. The most dangerous moment in any market is not panic, it's calm. Panic tells you something is wrong. Calm tells you everything is fine, right before it isn't. Silver was calm because it was being compressed, like a spring held down under enormous pressure. Once released, springs don't move slowly, they snap. The final moment before the open. By the time the market opened, the outcome was already decided. Liquidity had left the building. Sellers had stepped aside. The order book was hollow. All that remained was one question. What happens when the first real order hits a market with no atmosphere? The answer came instantly. Price didn't climb. It skipped. And in the next part, we will break down the exact moment silver broke free. How a routine buy order triggered a vacuum. And why the price didn't stop at $73 or $74, but printed levels no one was prepared for. Because this wasn't a rally. This was a structural failure. And the warning shot had been fired. At exactly 8:30 a.m., the market opened. No fireworks, no headlines, no chaos on the surface, just another quiet holiday session. Or at least, that's what it looked like. But underneath that calm surface, the structure was already gone. Because markets don't break when people are screaming. They break when nobody's watching. The order that shouldn't have mattered. The first buy order hit the system. It wasn't massive, it wasn't aggressive, it wasn't historic. Roughly 500 contracts. In a normal market, that kind of order barely registers. 10 cents maybe. A small ripple. But this was not a normal market. This was Ghost Week. And Ghost Week changes the rules. What traders expected to happen. Here's what should have happened. The buy order hits. Sellers step in at $72 to $50. Price pauses. Some profit taking, some resistance. Then maybe $73. Then a pullback. That's how a healthy market behaves. It breathes. It fights. But yesterday the market didn't fight back because there was no one there to fight. The first shock. No sellers. The matching engine scanned the order book. No sellers at $72.50. That alone was strange, but not yet alarming. Then it scanned higher. No sellers at $73. That's when the first red flag appeared. And then higher again. No sellers at $73.50. At this point, the market wasn't moving. It was searching for anyone willing to sell and finding no one. How the matching engine really works. Oh, this is critical to understand. Markets don't decide prices. Algorithms do. The matching engine's job is simple. Find a seller. Match the trade. If there's no seller at one price, it moves up and up and up. It doesn't care about logic. It doesn't care about valuation. It doesn't care about fair price. It only cares about execution. And yesterday, execution required a jump. The moment price teleported, eventually the engine found a seller. Not at $72, not at $73, not at $73.50. It found one near $74. And when that happened, price didn't glide. It leapt. Cents were skipped. Levels were erased. Silver didn't climb the ladder. It took the elevator. This is what traders call an air pocket. What is an air pocket? An air pocket is what happens when liquidity disappears. No bids below, no offers above, just empty space. In an air pocket, gravity doesn't apply. Price accelerates because there is nothing to slow it down. Think of it like this. In normal conditions, liquidity is atmosphere. It creates drag, resistance. Remove the atmosphere and price behaves like an object in space. It doesn't fall, it floats, then it launches. Why this was not a short squeeze. This is where the mainstream narrative gets it wrong. They'll tell you this was a short squeeze, that traders panicked, that buyers overwhelmed sellers. None of that is true. This wasn't panic buying, this wasn't FOMO, this was structural absence. Short squeezes require aggressive demand. Yesterday did not. Yesterday required only one thing, no sellers. And that's far more dangerous. When shorts realized the exit was gone, short sellers rely on one assumption. Liquidity will be there when they need it. Yesterday shattered that belief. Because when price jumped, stop losses didn't trigger smoothly, they cascaded. Each forced buy order pushed price higher. Each higher print forced more liquidation. But here's the key. This liquidation didn't cause the move. It amplified it. The move was already happening. The 75 print. Then it happened. 75.14, a number that didn't exist on anyone's risk model. A level no one expected to see during a holiday session. The all-time high wasn't tested. It was destroyed, obliterated. Traders in London went to lunch with silver in the low 72s. They came back to find their entire short book gone. Liquidated without mercy. Why this was a market dislocation. This wasn't a rally. This wasn't a trend. This was a market dislocation. A moment when price disconnects from expectations, from positioning, from comfort. Dislocations happen when systems stretch too far, when leverage replaces liquidity. And yesterday, that system snapped. Why the move stopped, for now. Eventually, price stabilized. Not because the problem was solved, but because the session ended. The market closed around $74.50, not a pullback, a pause, like a runner stopping only because the track ended. The energy didn't disappear, it compressed again. Who won and who lost? The winners were invisible, those holding physical metal, no leverage, no margin calls, no counterparty risk. The losers were loud, paper shorts, over-leveraged traders, anyone who believed calm meant safety. Why this event changes everything. Markets remember moments like this, so do risk managers. So do institutions. Once liquidity vanishes once, everyone knows it can vanish again. And next time, they won't wait. They'll front-run the exit, which is why this move doesn't end here. The warning inside, the move. Yesterday wasn't the squeeze, it was the warning shot. It showed what happens when control is lost, when price escapes the paper cage. And in the final part, we're going to explain why this structure cannot be rebuilt, why suppression no longer works the way it used to, and why the next wave doesn't stop at $75. Because once a market discovers there are no sellers, the only question left is how high it needs to go to find one. Markets don't collapse loudly. They don't announce the moment control is lost. They whisper first. And if you ignore the whisper, they eventually speak in prices so violent that explanations come after the damage is done. What happened to silver was not a surprise. It was a confirmation. Confirmation that the system no longer functions the way people believe it does. The biggest misunderstanding. Most people think yesterday was the event. It wasn't. Yesterday was the evidence. The event happened years ago, when paper promises replaced physical reality, when leverage replaced inventory, and when price discovery became a managed illusion. What you witnessed was simply the moment that illusion failed in public. Why this was never about $75 fixating on $75 misses the point entirely. $75 wasn't resistance. It wasn't a target. It wasn't even a decision. It was an accident, a byproduct of a broken structure searching for balance and failing to find it. Markets don't stop where traders expect. They stop where liquidity exists. And yesterday proved something terrifying. Liquidity no longer exists where the models say it should. The death of price control. For decades, silver's price was controlled by abundance. Not real abundance, synthetic abundance. Contracts, offsets. Paper supply, created faster than metal, could ever be mined. This worked for one reason only. Everyone believed the exit was always there. Yesterday exposed the lie. When the exit disappeared, control vanished with it. You cannot control price. In a market where sellers refuse to appear. Why suppression always fails the same way? Suppression never ends gradually. It always ends suddenly. Because it depends on confidence. The moment participants lose faith that the price is real, they stop playing defense. They stop selling. They stop providing liquidity. They step away. And when that happens, price doesn't drift higher. It gaps. That's what you saw. The critical shift. No one is talking about. The most important change is not price, it's behavior. Institutions saw something they fear more than volatility. Illiquidity. Volatility can be hedged. Illiquidity cannot. Once a market proves, it can gap violently during a low-volume session. Risk managers recalibrate everything. Position sizes shrink. Short exposure evaporates. Demand for physical certainty rises. This is how trends are born quietly. Why? $100 is not extreme. The idea that $100 silver is crazy only makes sense if you believe yesterday shouldn't have happened. But it did. $100 is not a moonshot, it's a repricing. A recognition of years of suppressed value released all at once. When pressure is released slowly, you call it inflation. When it's released violently, you call it shock. Silver is entering shock. The math people avoid. At $75, silver was already screaming. At $100, it simply becomes honest. Honest about mining costs, honest about scarcity, honest about demand from energy, technology, and defense, and honest about how little real metal exists compared to how many claims are written against it. Paper markets survive on trust, physical markets survive on inventory. Only one of those exists in sufficient quantity. Why the next move is more dangerous than the last. The first jump shocks people, the second jump convinces them. Once participants believe a market can move without warning, they stop waiting for confirmation. They front-run fear. That's when moves accelerate. Not because demand explodes, but because supply withdraws completely. This is how parabolic moves are born. Who the real survivors are. The survivors were decided long before yesterday. They are not smarter. They are not faster. They are simply positioned outside the system. They hold metal, not margin. Reality, not promises. They don't need liquidity. They don't fear gaps. They sleep while others scramble. Who the real victims will be. The victims will not be late buyers. They will be believers. Believers in stability, believers in models, believers that price must behave rationally. Markets are not moral, they are mechanical, and broken machines don't care who trusted them. Why this story doesn't end here. Markets don't forget dislocations. Neither do traders, neither do institutions. The next time liquidity thins, the reaction will be faster, more aggressive, because now everyone knows what happens when gravity disappears. The final warning. This market is no longer about upside. It's about survival, about which assets remain functional when trust erodes. Silver has crossed that line. It is no longer asking permission. The final truth. Calm was the lie. Stability was the illusion. Yesterday didn't break silver. It exposed the system that tried to contain it. And once a market proves that it can escape control, it never goes back quietly.